Good morning, everyone. Welcome to another RF Crypto video. On today's market, we see another decrease from yesterday by almost 1.5%. The global crypto market cap now stands at 2.05 trillion. Bitcoin is down by 2.5%. Ethereum is down by 3.5%. BNB is also down by 4.13%. The rest of the market is quite down by between 3 and 8 or 9%. Cardano is up. Oh, now it's down. It was just up by 1%. The price just dropped. Polygon is up by almost 2%, but the market looks to be trading laterally. There aren't any massive movements aside from Terra, aside from Polkadot. Everything is moving laterally between 1 and 5 or 1 and 7%, which isn't a big jump for risky assets, which are cryptocurrencies. Bitcoin is down by 0.5% over the last 7 days. But other cryptocurrencies are up. Some are up by 30%, some are up by 12%. So you can see that the market is becoming less and less correlated with Bitcoin. Bitcoin can move in one direction, and then other cryptos can move in other directions. So it's a trend where cryptocurrencies are getting their own ground, they're getting their own footing in the industry, and they're becoming independent, sort of away from Bitcoin, away from Ethereum, and establishing themselves as we are our own cryptocurrency system, and we have our own factors which cause our prices to move. It's not only if Bitcoin goes up, we go up, or if Bitcoin goes down, we go down. It's a maturing industry. Obviously, in the beginning, everything was concentrated. Everything was Bitcoin, Bitcoin, Bitcoin. But as it matures, as it gains more and more use cases, there will be different factors that will move some cryptocurrencies that won't move others. And this is what's happening now. On some news, Crypto.com expands $200 million fund to $500 million. So John Russell, the new hire general partner based in Bangkok in China, told CoinDesk that the fund will do seed and Series A deals, typically up to $10 million per Series A deal. In March 2021, they announced a $200 million fund to invest in these Series A, in these seed deals, but now they increased it to $500 million. And this just goes to show that they have increased interest in investing in seed projects. They believe that there are a lot of projects that are worth investing, and that there will be future projects that will also be gems that will give them massive returns. And mostly they will focus on DeFi, NFTs, and gaming. Not only will they focus on these rounds, and not only will they want to invest in these rounds, but they will want to lead the rounds. It's a good marketing scheme as well, because if, let's say, for example, there are 10 investors that invested in a certain DeFi company, and Crypto.com invested the most. They led the round. The headlines will all say XYZ raised $10 million in a Series A funding round led by Crypto.com. So the name Crypto.com will appear there. It's almost free advertising. It's almost free advertising, but at the same time they have to invest a lot of money. But even though they have to invest a lot of money, they're going to get returns from it as well. So it's a win-win situation for them. And also, if they lead rounds, they're the ones that are going to invest more. And if they invest more, the return potential is higher. Obviously, there is a risk of loss because it is still a risky market. But I'm sure that they have some brilliant minds working to determine which projects are going to do well and which projects are going to flop. But despite that, even if you do your whole research, projects can still flop because of any number of factors, like a black swan event or a gray swan event, or just unexpected management issues. But overall, if they invest in 10 funds, it will probably be a 70 to 80% success rate, which the gains will more than compensate for the losses. And in 2021, crypto firms raised $30 billion from VC funds. And despite the bear market, or the bearish sentiment that's going on in the market, that the price of Bitcoin fell from 69,000 to now 41,000. So they're calling it a bear market. Despite this, there's no sign of slowing down, as alongside Crypto.com's capital announcements, FTX kicked off the year with establishing a $2 billion venture fund to invest in crypto startups. So Crypto.com, FTX, Coinbase, Binance, they're all investing in these startups, and instead of slowing down because of the bear markets, they're actually speeding up. They're investing more. More money is flowing into these projects. And the fact that they're focusing on DeFi, NFTs, and gaming means that that's where the growth probably is. Obviously, there is still growth in crypto, but 10x, 100x returns are probably not going to be seen in those anymore. Paradigm leads a $110 million investment in Bahrain's first licensed crypto brokerage. Bahrain-based cryptocurrency exchange Rain Financial has raised $110 million in a Series B funding round, co-led by Paradigm and client Kleiner Perkins. And as I said before, with Crypto.com wanting to lead rounds, if you can see here, Paradigm leads $110 million investment. So their name is on the title. That's advertising. The company will use the capital to pursue licensing in additional countries, enhance its technology platform, and expand the team. A managing partner in Paradigm said that they believe that Rain is a crucial piece of the puzzle for bringing Middle East deeper into the new crypto economy. Other participants in the round, including Coinbase Ventures, Global Founders Capital, MEVP, Cadenza Ventures, Jimco, and CMC Digital, which are major VC funds, and also VC arms of exchanges such as Coinbase Ventures, who are pouring large amounts of money into these projects which they believe in. Rain Financial was founded in 2017, and it became the first licensed crypto asset service provider in the Middle East 2 years later. And the company now has subsidiaries in Bahrain, Turkey, and UAE. Rain said that it hosted over $1.9 billion worth of transactions and amassed over 185,000 active users since its founding. The fact that they were the first in this industry, or they were the first players in a nascent industry where people were still very reluctant on what crypto was, gave them a beginner's advantage in the sense that they were established before everyone else, so people trust them more than anyone else. And the sheer number of transactions and the number of active users gives them an even bigger advantage. Malaysia's central bank is actively assessing CBDC options. They have joined the growing cadre of nations that are currently exploring the value of researching and developing a central bank digital currency, or a CBDC. In essence, a CBDC is basically a digital version of a country's currency. So for example, the USA has the dollar. So if they launch a CBDC, it would be called the e-dollar, which would be controlled by the Federal Reserve Bank, and it makes it easier to control because every single coin that they issue can be tracked. If I pay for services using my e-dollar, it can be tracked where I spent it. The printing or the minting and the supply of these coins are controlled by the central bank. Malaysia's central bank, Bank Negara Malaysia, stated to Bloomberg on January 17 that while a decision about exactly how to move forward with the CBDC has not been determined, it has focused research on a CBDC via a proof of concept and experimentation to enhance their technical and policy abilities. And in 2021, Malaysia collaborated with South Africa, Australia, and Southern Asian neighbor Singapore to develop a proof of concept CBDC pilot called Project Dunbar. Project Dunbar utilized the Corda and Quorum blockchain platforms from R3 and Coinsensus respectively to demonstrate various capabilities of blockchain-based cross-border remittances. So if you want to transfer money from one country to another, you would use MoneyWise or you would use Western Union. I'll get to that just now. Most notably, it aimed to demonstrate how blockchain technology could eliminate the need for intermediaries and cut the time and cost for these transactions. So you want to send money from Portugal to Australia. You use Western Union, it's an intermediary. You pay a massive fee, it takes time to reach there, and these disadvantages make it less palatable to engage in these transactions. But using blockchain and using blockchain-based cross-border remittances, it will be cheap, it will be quick, and it will cut the need for these intermediaries. You send a remittance from Portugal to Australia in 1 second for, let's say, 1 cent. And this is what's so attractive about these cross-border CBDC proof of concepts. Binance destroys 1.6 million BNB tokens in first ever auto burn. Cryptocurrency exchange Binance implemented its first ever Binance token auto burn program last quarter, so Q4 2021, removing over 1.6 million BNB tokens worth $750 million from circulation. Under the new program, the number of tokens to be burned is arrived at using a formula based on the total number of blocks produced on the Binance Smart Chain. And the move away from the previous token burn methodology, which was based on revenue generated from the Binance centralized exchange, is expected to make the process more objective and clear to the BNB community. Binance is actually committed to destroying 100 million BNB tokens, amounting to 50% of its circulating supply through quarterly burns. So every quarter they will burn a certain amount of tokens in order to reach this target of 100 million BNB tokens. And since they implemented the program to burn tokens, they have destroyed nearly 35 million tokens via this type of quarterly burn. And token burns are supposedly deflationary and usually meant to bring a store of value appeal to cryptocurrency. So if you have a sort of currency that has 100 million coins and the demand stays the same, the value of the coin, it just remains the same. But if you have a token that is deflationary, so this quarter it's 100 million coins, next quarter 95, the other quarter 90, and so on until it reaches a limit of, let's say, 60, and the demand remains the same. It's simple economics. There is more demand for less supply. And what happens when there is more demand and less supply? The prices increase. It means that these tokens are now burning in order to create a store of value appeal because, as I said before, less tokens available in the market with the same amount or a higher demand indicates higher prices. So it becomes attractive to investors because it will offer them higher returns. And just a side note, in traditional finance, deflation means a consistent price decline. So when we talk about deflation, we mean in 1 year, the price of bread is $10. In the next year, it's $8. That's deflation. The price deflated. However, in crypto, a deflationary token is the one whose circulating supply will decrease over time, thus making it a inflation-resistant token or a store of value asset. Just because there is less available of it in the market, it stores its value through market forces of demand. And it seems like more and more of these tokens are opting for this deflationary method because it creates a store of value narrative that attracts more and more traders. On other deflationary news, Ethereum EIP-1559 upgrade launches on Polygon to burn MATIC. The Ethereum upgrade that introduced a partial network fee burning mechanism in August last year has launched on the Layer 2 scaling solution network Polygon. The upgrade was launched to improve fee visibility. It introduces the same fee burning mechanism to Polygon, and it results in the destruction of MATIC tokens. It also removes the first price auction method for calculating network fees, and it leads to better cost estimation. Based on this upgrade, the team stated that just like Ethereum, the supply of MATIC is likely to become deflationary, which means that the supply of MATIC in the market will decrease, with a 0.27% of total supply being burnt every year according to estimations. There is a fixed supply of 10 billion MATIC tokens with 6.8 billion currently in circulation. So if you have 10 billion MATIC tokens and 0.27 of the total supply will be burnt, that means that 27 million MATIC tokens are going to be burnt every year. But this 0.27 of course can increase with time. And if this is the case, then there will be, as I said before with the BNB token, there will be less supply of MATIC in the market, and with more and more adoption of the Polygon network or more apps being built upon the Polygon network, this will mean that there will be an increased demand for MATIC tokens because MATIC tokens are necessary to operate in the Polygon network. If the demand increases while the supply is decreasing, the price has a tendency to go up. Another thing is that deflationary pressure will benefit both validators and delegators because the rewards for processing transactions are denominated in MATIC. Because these validators and delegators are in the Polygon network validating transactions and due to the proof of stake concept, their rewards are going to increase. Because if the price keeps increasing and their rewards that are in MATIC, if the rewards remain the same per block or per transaction that they process, that means that the dollar value of their MATIC will increase just because of the increase in price. And since going live on Ethereum around 6 months ago, this upgrade, the EIP-1559, has resulted in the burning of 1.54 million Ethereum. At current Ethereum prices, this will work out to $5 billion. It's also predicted that Ethereum issuance will become deflationary by negative 2.5% per year once the merge happens and proof of stakes becomes the primary consensus mechanism for the network. So 2.5% a year means that in 20 years, the supply of Ethereum will be reduced by half. And you know that Ethereum is not going anywhere. You know that Ethereum is the king of DeFi. And if the Ethereum 2.0 update comes out, and if it's successful, the demand will increase. And the fact that in 20 years, half of the Ethereum supply is expected to be gone, and only half is to be remained, and if we expect the demand to go up, it's only logical that Ethereum has an upward trajectory and is a very, very, very good long-term hold. This isn't financial advice, this is financial opinion, it's my own opinion, but I think that this is going to happen because of these deflationary mechanisms that are in force that will cause the supply of Ethereum and the supply of other tokens that are in the Ethereum network to decrease with time. And we won't see this with Bitcoin, but don't forget that Bitcoin has a limited supply of 21 million coins, and it's not going to go above that, and it's not going to go below that. And the fact that a lot of coins have been lost, a lot of Bitcoin coins have been lost through theft, through lost keys, through forgotten passwords, through the death of these wallet holders, means that the supply won't be 21 million, but 16 million or 15 million, or even less with time. It's sort of deflationary in its own way, because if someone loses their tokens, that means the supply goes down. That means it's deflating. We can see probably a similar trajectory with Ethereum as with Bitcoin. And with that, we come to the end of today's video. If you like the video, please leave a like and please hit the subscribe button, share it with your family and friends, and I will see you for the next video. Invest wisely and cheers.